The voice of the Cayman Islands, Radio Cayman.
We love our listeners.
Radio Cayman in the Cayman Islands. Money Sense is brought to you with the support of OneTradeX. OneTradeX, the Cayman Islands' #1 choice for online brokerage. OneTradeX knows there's more than one way to invest. OneTradeX is the Cayman Islands' only fully licensed online broker-dealer, offering discount trading services to individual investors and traders, hedge fund managers, and family offices. OneTradeX has the most competitive online trading prices of any offshore broker worldwide, with no custody or management fees, free demonstration accounts, and no charge to open an account with a $5,000 minimum deposit. Trade stocks, options, futures, bonds, and Forex. Learn more and open your free demo account today at OneTradeX.com. OneTradeX, the Cayman Islands' #1 choice for online brokerage. OneTradeX is licensed to conduct securities investment business by the Cayman Islands Monetary Authority.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
Good morning and welcome to Money Sense. Your hosts today are myself, Amy Hubble, joined in studio today with Emil Kalinowski. Good morning, Emil.
Good morning.
We are excited to be joined in studio this morning by David Brose. David is the Chief Investment Strategist at Barometer Capital Management, a $2 billion portfolio management company based out of Toronto. David, I think welcome back is in order. You have been on the show before, albeit not with Emil and I.
That's right. I had the opportunity to do this show last year, so I'm happy to be back.
And escaping the cold.
Very happy about that.
Absolutely. Well, let's kick it off today. I think our topic today is just basically macroeconomics and the markets in general. And I know that's kind of your specialty, so I hope to have just a good roundtable discussion about where we are and where we are going. And just as a note, we are pre-recording, but today is the last day in January, so that's the view we'll be taking for now. But your year-end macro outlook, and really everyone's year-end macro outlook, was a little bit less than positive, or at least kind of the expectation that we were probably heading into a bear market. Yeah. What's changed? Has anything changed?
So our macro view, in fact, was that we were seeing the tail end of a bull market, a correction in a bull market. We've been of the view that we are in a structural bull market for equities, which is likely to go on for a very long time. Like in the 80s and 90s and like in the 50s and 60s, they have interruptions. But the interruptions tend to be more like 2 to 4 months. And the magnitude is 7 to the outside 20% declines, and it tends to be in the leading groups that get corrected, but that they turn around and run away to the upside very quickly, leaving people sort of shaken out on the sidelines.
And I'm sorry if you're going to continue, but let me just ask quickly, we have an international audience, so which equities are you referring to?
Right.
It's my understanding there's a divergence between U.S. equities and the rest of the world, which seems to be struggling for the last few years.
Right. So clearly it's U.S. equities that have been leading, and over that period, developed markets have been leading emerging markets, right, since 2008, which is typical, right? They tend to have their own bull markets at different times. And clearly we went into correction led by China and EM last year, and it went on like 16 months. And Europe joined in. And, of course, in a sell-off, the strongest asset gets hit last. And the U.S. market got hit last. And, of course, the strongest part of the U.S. market, tech, got hit at the very end. And, interestingly, it's the first group that turned higher. Now, EM, emerging markets, equities, actually, on a relative basis, started to rally last summer as their currencies started to repair. So, in fact, Brazil and Latin America have been leading. But the U.S. clearly is very strong. Europe is in a different situation, right?
Why won't you say Europe's in a bad
Very
situation?
Different.
I'm going to add
a different situation.
Well, I'm going to say that they seem to be falling into recession. Some countries are. Italy has. Germany's on the cusp, and it doesn't seem too well. It seems like economic activity is slowing down. Why won't that spill over into the rest of the world if they are in trouble?
Well, I mean, so we have to look at what matters, right? We know that actually China means very little to the U.S. as far as a contribution to GDP. We know that it matters a lot more to Europe, right? A lot more, which is why Europe tends to go down when EM goes down. We know that, for instance, in this quarter, as we're reporting, gross margins, profit, and revenue have surprised against expectation in the U.S. in each of those three categories. In Europe, they've missed so far in this earnings period. So there's a big divergence. But the U.S. is the largest, almost self-contained economy in the world, right? 70% of it's the consumer. And a big percent of it is industry serving the consumer, like healthcare. So I know we worry about the rest of the world, but the U.S. market is doing what it would be doing if it's the leader, breaking down last, being the first to reverse. And if we've seen the end of the rate hike cycle, then it's very possible, and I believe you see a soft landing in the U.S. like you did in the mid-90s, 1995, where the economy slowed down all year long and the market rallied 38% looking through that slowdown.
Do you think that that's something that, I guess, countries should strive for, is kind of that isolation from the contagion of other issues? So you say that the U.S. is somehow sheltered from the problems of China, the problems from Europe, and can continue to grow on its own. Are there any other countries that are trying to emulate that, or should they?
Personally, I think that's a big mistake, because there's times when you really want, and industries certainly where you really want that international customer. I think that's a very misguided isolationist strategy. And we can see that at some point, weakness in other parts of the world really matters to the U.S., right? It gets to a point where people say, well, maybe that's going to drag the U.S. into some kind of a slowdown as well. I'm just saying it's more immune than A, people think, and B, than other countries, right? Arguably, when you've got the biggest economy and a big consumer base, everybody wants those customers.
I want to challenge you a little bit with the analogy you made to the 1990s. Mm-hmm. It seems like that era was different from this one with respect to the growth in money, for example. And that's why I think the 1990s were such a great boom for the United States and the rest of the world, is because there was a lot of supply of money. Whereas today there seems to be a shortfall of it. There seems to be a shortage of dollars to go around in the world. Have you heard of this thesis, the idea that there's a big dollar short and people are fighting over dollars to be able to meet their debt obligations, for example, and thus there's this general economic lethargy since 2008, completely unlike the 90s, which were go, go, go.
I think it's actually quite different than that, because I think that there is been tons of liquidity. Okay, now liquidity comes in different ways. Last year's concerns are Fed balance sheet runoff and Fed tightening. That's maybe the liquidity is going away. But actually, if you go back to 1998, for instance, the Asian currency crisis and long-term capitals collapse and the Russian rubles collapse, that was a dollar shortage. And in particular, it was a problem because those countries had so much dollar-denominated debt, more so than today. So I don't agree with that. And then I guess I would then look to the market to tell me. And as we look at it right now, yes, certainly dollar rallied toward year-end, and there was a fear of a dollar shortage at year-end. But here, there wasn't one. Market rallied off that at the end of December, equities, and U.S. dollar has been backing off since then. So unless the dollar really starts to rally again, I have a hard time seeing how there's a dollar shortage. It's possible. It's possible.
Yeah, I guess I would like to ask when that reckoning is going to happen, though. I guess with rising interest rates, and we'll talk more, I think, later in the show about Fed policy. But with rising interest rates, I don't understand how we can't have kind of that depression in liquidity, as well as ultimately an issue of this at least pause on the rallying dollar. Right. Now, I know this is also going to depend on what the rest of the world needs in terms of the dollar. But when does that happen, or does it happen?
Yeah. So I've been managing money now for just under 40 years, and I don't think there's a week that's gone by where somebody didn't say, but what about the U.S. debt? This is going to be a big problem. I never would have made an investment had that been the issue. We know that if there's going to be a debt problem, it's not going to show up in the strongest bond market in the world first. It's going to show up somewhere else, like, say, Italy or Greece or Japan, which has tremendous debt to GDP, but it's not there. So until that happens, you shouldn't worry about it, because what that debt doesn't take into account is the assets on the other side of the balance sheet. And every central bank around the world since the crisis has been working at reflating assets to help offset the impact of debt on the other side. Rates can only go up as quickly as we can inflate asset prices, because that's the collateral. So I think they will be very, very careful not to cause some kind of a depression in asset prices. That would be a big problem.
Yeah, and I tend to agree with you. I know Emil does disagree with me. But from my perspective, the U.S. debt is a non-event, just because we're continuing to be able to auction 30-year treasuries for 3%. And I believe that if you can continue to sell out an auction for 3% of 30-year debt, you should do it every single day until there's no longer an appetite for it. And if it becomes a problem, we can print money.
Listen, absolutely. But then I would say, let's take that and go to a second derivative and say, okay, fine. So U.S. dollar is probably okay. Why do I want a 3% or 2.75% treasury when I can buy U.S. equities with a 6% cash flow yield that's growing every year? That's a really good premium I'm getting paid to take risk. So I think that's a pretty constructive backdrop. A little bit of inflation, a little bit of cash flow growth, a little bit of dividend growth goes a long way in a low-rate world.
Yeah, why would you buy? Who is buying these long-term treasuries?
People who are worried about liquidity risk are buying them, not solvency risk. I'm in agreement with both of you regarding the United States debt problem and other reserve currencies, let's say. It's not solvency that's immediate concern. That's sometime out into the future. It's the immediate liquidity concern. And that's what I believe we are facing, or at least what we saw during 2018, where we transitioned from a period of globally synchronized growth, which was trumpeted by all the international agencies and economists around the world, to something very strange. In just a few months, all of a sudden we were going the other direction, whereby Germany, Italy, and other countries, Japan reporting 2 out of 3 quarters of negative GDP, suggesting to me that there's a monetary liquidity crisis, again, that's transmitting itself through the financial system and into economic activity.
I don't disagree there's slowdown. But when you look at credit markets, say corporate credit, investment grade or high yield, yes, spreads widened over sovereign debt, but nowhere near what they did in 15, 16, and not even comparable to what happened in 8 and 9. So I would say that's more typical mid-cycle slowdown. It doesn't, to me, look like some kind of a structural change. I don't disagree that you can't see rates move up too quickly. And both sell-offs in U.S. equities last year happened when rates moved up on a 10-year too much, too quickly. People said, oh, that's scary. But that was the economy saying it's strong, not that it's weak.
Yeah, absolutely. Well, we are going to have to take a break. Let me put both of you on the spot right quick before we go. In the next 12 months, do short-term rates go down or do long-term rates go up?
I'll let the guests go first.
I'm going to say that short-term rates are on hold, and long rates after a pause probably steepen later next year.
So up.
Yeah.
Both ends go down as people move towards safety.
Well, neither of you answered that question, but we are going to take a break. So join us back after our short break as we continue our conversation with David Burrows.
One TradeX knows there's more than one way to invest. One TradeX is the Cayman Islands' only fully licensed online broker-dealer, offering discount trading services to individual investors and traders, hedge fund managers, and family offices. One TradeX has the most competitive online trading prices of any offshore broker worldwide, with no custody or management fees, free demonstration accounts, and no charge to open an account with a $5,000 minimum deposit. Trade stocks, options, futures, bonds, and Forex. Learn more and open your free demo account today at OneTradeX.com. OneTradeX, the Cayman Islands' #1 choice for online brokerage. OneTradeX is licensed to conduct securities investment business by the Cayman Islands Monetary Authority.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands and sponsored by One TradeX.
And now, more Money Sense.
Welcome back. In the second half of today's show, we're going to continue our conversation on the markets with David Burrows of Barometer Capital Management. Before the break, we were talking about kind of the global macro environment that we're in and how we got here. For the second half, I'd like to pivot a little bit of just what are you telling your clients right now? What are your clients asking? What are they worried about?
Right. Well, clearly, after 2016-17, just about the lowest volatility for equity on records. 2018 sort of was a return to normal. And against a low volatility backdrop, it seemed gargantuan to them.
Do they care about volatility on the upside, or is it really the pain on the downside?
No, they're all afraid of downside because realistically, private investors and institutions still suffer from PTSD related to the financial crisis in 2008-9 and 2001-2. And you could see it because in the month of December was the largest 4-week outflow from equity funds and ETFs in history, like by an order of magnitude, maybe 5 times the worst month in 2008. So that was, oh boy, you're not going to do this to me again. I'm getting out.
And we expect those are mostly retail investors or
you
or
would
the dumb
think,
money.
but the hedge fund community went 100% net short the market. Now, I wonder how that feels right now, given what's been happening in January. But that's the risk. So risk comes in 2 ways, right? Risk can come that your investments go down in price. Another risk is you're sitting on the sidelines when the market makes one of its great leaps forward, which is what's happening in January. So sadly, the market does what hurts the most people.
Yeah,
that's so true.
Best January in 3 decades, is that?
Right.
Following the worst December ever, if I remember correctly.
And
that's how it usually
like
is.
another interesting stat from 2018 is that in 2018, 90% of investment assets fell in price. No year in 100 years is like that.
2007 or
2018, yeah. So that did shake people's confidence, and understandably, because very difficult news flow on the trade front and on investment on Fed funds policy, and certainly out of the crazy Trump White House. That's scary. But there's always difficult things in the backdrop, and the market discounts it and then moves on. So I think that's what's bothering investors the most.
David, I hate to be the rainy cloud in our beautiful Cayman skies, but that's my role here. Okay. Post-traumatic stress disorder, that's what you're saying investors are suffering from because of the 2001 and 2008 crises. And of course, we look at that and we say, that's unreasonable. That was more than 12 years ago. What about this idea? What if they were also suffering from the events of 2011 and 12, the sovereign debt euro crisis, and the events of 2014, 15, and early 16, when we saw emerging markets such as Brazil, China, Russia crash and suffer tremendously? So, could we say that they are operating under the fool me once, shame on you, fool me twice, shame on, well, you know how that saying goes. I messed it up. But you see where I'm saying? Maybe
absolutely.
It's happening more often.
It's absolutely true because people are a product of their own experiences, right? What seems like a long time to a private investor in the scheme of the market actually is not that long. And so, I started in the investment business in the early 1980s. And I talked to people in 1986 4 years into an 18-year bull market where the market went up 18% a year, and the only thing they could point to was all the problems of the 1970s and how, they weren't going to be fooled again, right? And so, in reality, there have been three big financial crises in the last 100 years. You had 1929 through 32, which was a recession that turned into depression because of a financial crisis. You had the 1973-74 bear market, which was also a 50% decline in the stock market. And then you had 2008-9. All three of them were 50% plus declines. They were 45 years apart. And it tends to be that once you've had those kinds of crises, it stays in people's minds. The Depression babies did not buy the stock market in the 1940s. It was new investors in the 40s and in the 50s. So, yes, I think you're absolutely right. It doesn't mean that they're correct.
So what does one do? Because we have different opinions. Does one have a balanced portfolio at all times because one doesn't know what will happen? So you have the all-weather portfolio and you have a quarter in each of the major asset classes because you don't know, or do you overweight? How do you know when to lean in one direction?
Right. So I think that you have to understand the structural backdrop. Right? Equity bull markets tend to go on 12 to 18 years. Bear markets in bonds, or bull markets in bonds, 25 to 35 years. So we saw structural low in rates in 2016, which was around the same level they bottomed in the late 1940s. They had fallen from 1901 to 47. From 1947 to 81, rates slowly, and I mean slowly, went higher. Took 15 years to get from 1.6 to 5.5. But during that 15-year period, the economy was reflating and stocks went up 10 to 1 versus bonds. So I actually...
What was that period again?
From 1951 to 66, bonds generated a total return of 1.6% a year. Inflation was 1.6% a year, so there was a 0% real return. Bond proxies, sectors that act like bonds, consumer staples, utilities, telcos, also 0% returns. The stock market went up 15% a year. And it started by being hated. And by 1970, everybody owned the 50 most prolific dividend-paying stocks, and they traded at 80 to 90 times earnings. So that's a long cycle. So I would argue that we started probably a generational low in rates in 16. We probably will see slowly rising rates for the next 15 to 20 years. I mean, remember, in 16, you had two-thirds of the world's bonds trading at a negative yield. So to think that at one point, at now 2.7% in a 10-year bond with inflation at 1 to 2, that you're going to actually make any money is tough. Last year's two big sell-offs happened when rates went up in February and up in October, fearing the economy was too hot. Of course, by the end of the sell-off, people are saying we're going into recession. My only point is to just say I'm going to have stocks and bonds 50-50 or 60-40. That's why people felt it last year, because the bonds didn't go up the way you would expect when stocks sold off. So it felt like a much rougher ride. And that was the way it was all the way through the 50s and 60s. That could be the way we're facing for the next 20 years.
Yeah, that's, excuse me, that's the conversation I've been having with a lot of my clients is, when you're building a portfolio, you have kind of your risk assets, which are mostly equities. You're going to get growth, you're going to get volatility, and then you're kind of hampering that volatility in the equity markets by having kind of safe stuff, which has traditionally been your bonds and your fixed income or your cash to kind of offset some of that volatility for either reasons of making your portfolio a little bit smoother ride so you can sleep at night, or maybe you have a need for liquidity, or maybe you're about to spend it, or maybe you're approaching retirement and would just like to take some risk off the table. But then in December of 2018, you saw a steep decline in equities, so lots of downward volatility, which is all my clients care about. And then you also have the Fed bumping up interest rates one more time, which, as we know, rising interest rates means lower bond prices. So now I've got them calling and saying, I'm losing money in my safe stuff. How do we
So it's a great point. I'd love to just address that. Okay, so we think about stocks and bonds. And, I'm a multi-asset manager. We invest across asset classes, which include things like commodities and real estate and so on, long and short. There are real asset cycles and there are financial asset cycles. And we were talking before the show about the fact that commodities, for instance, are at a 20-year relative low versus stocks. So they're hated, right? And just like stocks don't go up forever, commodities don't go down forever. But they do move in different times. So I would argue actually that you probably would want to have today equity-like assets which handle inflation, reflation, because they grow their dividends and distributions and cash flows. And I would argue you probably want to be watching real assets like some of the commodities. And I pointed out early that I think actually, even though I'm not a gold bull, that gold and gold equities, for the first time in many years, actually look like they're bottoming out and making a turn. Now, if we thought rates were going to slowly go higher from here, two reasons to own equity or gold. One is disaster, which I don't think is in the cards. The second is if you're into reflation, then golds could be supportive and is more of a safe haven asset. So I think that it's probably a combination of those two types of assets over the next number of years. And you're not fist fighting everybody else to buy them right now.
Yeah, that's true. I mean, when I look at the returns for the last 10 years, I've got positive numbers in every single asset class except commodities. And that's, regardless of what you've been investing in, and we can talk about correlations between asset classes and what's the point of diversification if everything's correlated, except for commodities, which you have seen go down. And Emil, you're the expert there.
Well, there we have our financial commodities, gold and silver, and then we have our industrial commodities, which are being driven by China. So while I'm very happy to lean in David's favor with the gold and silver, we also have to consider how is China's next 10 years looking if you're thinking about investing in other industrial commodities. And then, of course, there's oil, which is closely related to economic activity.
And by industrial commodities, you mean things that are used, inputs to the building growth in China specifically.
That's right. Copper, nickel, lead, zinc, those kind of commodities. So there's a couple of commodity types out there.
Yeah. I would agree with that. I just, going back to asset mix, would err on the side of a lower fixed income mix. And you might look more, as opposed to a stable dividend growth type strategy, which is what can help offset rising rates and what led the bull market from 1951 to basically 1970, because people needed cash flow, but they were looking for things that could offset rising rates and inflation.
Oh, good deal. Well, we are running short on time, but I wanted to ask you one more question. Just kind of what does this all kind of have to do with investors here in Cayman? Is there anything that they, and certainly we don't want to be encouraging any of our listeners to go out and make any changes based on just what we've said here on the radio, but anytime you can be thinking ahead, continue to be diversified and...
Yeah, absolutely. I mean, interesting, we were talking about the makeup of the Cayman market and, the Cayman economy and its banking and its travel and leisure. Mm-hmm. And the reality is, I think that when I look at the sectors I'm focused on in the U.S., consumer discretionary would be my second biggest weight because the U.S. consumer and employment situation is really strong. So look at the boom that's happening here in Cayman, and maybe part of it's artificial because of the hurricane and Cayman coming through it well. But that looks pretty attractive. And frankly, if rates were to slowly go higher for Treasury bonds, the single biggest positive for financial services is rising rates. So I think ultimately that's probably attractive for financials, and U.S. financials certainly have come off the bottom nicely after a horrible December, but they're trading at about 1 times book value. So both of those industries probably are okay going forward.
Yeah. And you're a visitor, so you get to see the continued growth every year.
I'm doing my research in the travel and leisure industry while I'm here.
Well, good. Well, we're very glad that you could have joined us today. And as a final note, before we leave, we wish to once again thank all of our listeners and remind you that today's show will be heard as a podcast on the CFA Society Cayman Islands webpage. And encourage anyone who has a question or topic that they wish us to cover to please email us at moneysense@candw.ky. And don't forget to follow us on Twitter at MoneySenseRadio. We're glad to continue this conversation there. With that, thanks again to both of you. I think this was a good conversation and very, very topical and needed.
Thanks for having me.
Thank you, Amy.
Money Sense is brought to you with the support of One Trade X. One Trade X, the Cayman Islands' #1 choice for online brokerage.
Shaken yet standing firm. This is Radio Cayman in the Cayman Islands.